was just thinking, as Jonathan came up to the rostrum, that there's kind of one common thing between the former professors of innovation at Birkbeck, both Birgitta Anderson and Jonathan, is they're astonishingly thin. And I was just thinking that, you are, as a man with a body mass index of 28.5, if I'd be very happy to adopt let's discuss my having an association doing innovation with you. Perhaps I'd lose some weight. That's meant to be a joke, but I'm half serious. If you look, I mean, this is quite an apposite time to discuss this. Actually, the Prime Minister in the House of Commons today thinks that actually someone should be held for account for the £290 million fine that Barcap, the investment banking arm of Barclays, has paid to the American and British regulators for manipulation of Libor, the London Interbank offer rate, in the years between 2005 and 2009. And it's becoming obvious that investment banking was a massive ruse to make the people who worked in investment banking enormous sums of money personally, despite and because of the embedded conflicts of interest that investment banking grew up around. And actually, when a conflict of interest, when you knew what the result of a trade was going to be, because you knew, because you were acting for both the buyer and the seller, so you knew there were more buyers than sellers, so you knew which way, or more sellers than buyers, so you knew which way the price was going to move, so you could take a hell of a position. You could also take a hell of a position manipulating the cost of your funds through actually manipulating daily Libor. I mean, it stinks to high heaven, and the fact that in 2009 the Libor was still being manipulated, so that Barclays could pretend to the regulators that it was, it apparently had more creditworthiness than really it did have in the interbank markets, and the idea that was not known to senior management of Barcap and indeed Barclays is risible. As Martin Taylor, the former chief executive of Barclays Bank, said on the Today programme this morning. And it just dramatizes, actually, how bad the capitalism was in the decade up to 2008. And those of you who are attentive watchers of Newsnight, in fact, I used to work on Newsnight as economics editor and have been falling asleep in front of Newsnight for most of the last 25 years, even when I worked in it, actually. I made a phenomenal film once. It was a really great film, really kind of sticking it to whoever it was. And the producer rang up and said it was a complete outrage, and I couldn't make out what the outrage was. In fact, what had happened was they'd taken an internal edit on the film as it was being transmitted live. Unfortunately, I was fast asleep and unable to comment on why it was such an outrage that my film had been edited in mid-transmission. I realised then and there that time had come to kind of end my career on Newsnight, really. But that was another joke, actually. But Jeremy Paxman on Monday night to a woman who said that actually part of the Euro's problem was that the Eurozone, however badly designed it was, had interacted with a monumental debt crisis that had been manufactured in the United States and to a degree actually in London. The London-New York axis is he turned round on her and said that was arrant nonsense. I actually became kind of worried that it wasn't just Niall Ferguson kind of representing the Tea Party movement, giving the Wreath lectures, but actually the presenter of Newsnight, because as you'll see when I put some of these graphs up, the scale of the private debt crisis, which is morphing into a public debt crisis, could not have taken place without some of the rank bad capitalism that was practiced not only in the UK and the United States, but also in continental Europe. Never forget that the bank with the most leverage and the bank which had the highest proportion of its assets in its own prop trading desk derivatives was Deutsche Bank, followed by UBS, followed by Soc Gen, with actually RBS and Barclays actually in the middle of the pack. Continental banks were really into this game as well. What I'm going to do is I'm going to set out just my definition of good and bad, how to do capitalism well. I want to explain why I think that it was bad capitalism that got us into this crisis. I want to say a few words about what I think good capitalism constitutes. I want to, having made you suitably gloomy about the situation we're in, and it is a very serious situation we're in. In fact, I don't agree with Mervyn King about much, but I do agree with him that, and Jeremy Hayward, who last week, as you know, is Cabinet Secretary, Jeremy Hayward remarking that actually this public austerity will take place in Britain for at least a decade. And we're only 2 years into it. I don't think that what's going to happen to the UK over the years ahead is properly appreciated. My view is matters are so serious that there is no question that the coalition government will fall before 2015 because of the scale of the mistakes they've made. That's my view, maybe you can contest it. And I think that for the first time, our country has to think in terms of kind of national development as much as economic growth. The crisis that we're in is the most severe since the 1870s, 1880s. Even the 29-33 crisis, as you'll see, was of less scale than the current one, and recovery was quite smart compared with the recovery from this one. And that was aided and abetted by imperial preference, and there's no empire to have imperial preference with in 2012. A smaller crisis in the late 70s, early 80s, we were helped out of that by the first beginnings of a credit boom, interacting with the discovery of North Sea oil, which removed the balance of payments constraint. Can't do that again. North Sea oil is running out, and actually you can't do a credit boom twice, especially when your debt to GDP levels are as high as the ones we have. So for the first time, actually, the Industrial Revolution happens relatively spontaneously in Britain. For the first time, the British have got to think about how they develop their economy. And it doesn't come easily to anybody. It doesn't come easily to the Faculty of Economics in any of our universities. And I think the Queen's question was kind of well made to the London School of Economics. And the former director, Howard Davis, tore his hair out the fact that there were 37 economists on the faculty who, 2 years into the crisis, not one of whom had ventured an opinion about why it had happened or what the way out of it was. And the refusal of the Faculty of Economics to engage in it, and he, of course, is now on to higher things as a result of Libya. But the point stands. Officials don't think in these terms, and you can be sure as hell our financial and business elite do not think in these terms, and certainly not the members of Barclays trading desk, treating each other to bottles of Bollinger as they manipulate Libor. It's a huge culture change that we confront as much as a way of thinking about how to do economics. So, and I think that there's not time in 30 or 40 minutes, but I will make references to my ideas about fairness and the book I recently wrote called Them and Us, which is going to follow up to the state we're in, because underpinning all this good capitalism is a value system. I think is another thing to migrate to. Strongly think that actually a good capitalism is underpinned by notions of equity, not greed is good, and not egalitarianism. And fairness and equity are again subjects which actually the British instinctively get, but haven't actually intellectually and philosophically and politically thought through. As you can see, with nobody complaining that the Lib Dems, the Labour Party and the Tory Party last election all laid claim to be the party that would best do fairness. That can't be possible. One of them must be right and the others must be wrong, or the idea of fairness is so elastic it is meaningless, and I don't think it's meaningless. But let me just, there's a Q&A session at the end, so there's going to be some loose ends in this, because necessarily you're going to get the Will Hutton worldview, and there's going to be some shortcuts, and hold on to your safety belts, because some of what I'm going to show you is quite complex, but the non-economists in the room, don't get frightened. It's all simple, really. I want to start off by just saying a few words about what I think constitutes good capitalism. I feel very strongly, and this is the last of the preamble before we get to the slides. We're going to go to the slides at breakneck pace, but I do think that the way that we in Britain think about capitalism has been far too coloured by American neoconservatives. And I think that the fact there's 380 million Americans occupying an economy with $14 trillion GDP, 1/5 of world GDP, and the way that has a kind of hegemonic impact on idea generation and framing of the international conversation is hugely important. And some of the richest people in the world, like the Koch brothers, have spent a lot of money to get revenge, as they would see it, and a mistaken course, as they would see it, of the United States first in the 1930s instituting Roosevelt's New Deal, and secondly in the 1960s introducing LBJ's Great Society program, which led, as they would say to the stagnation and inflation of the 1970s, and they've been trying to get the United States back onto the path of true capitalism for the last 40 years, hence the Tea Party movement. And I think that their view of what constitutes good capitalism, trickle-down economics, people having light bulb moments in garages, entrepreneurialism is all, any regulation of the labour market damages the situation. Everything is down to free markets and people exercising free choice in free markets. I mean, you all know the litany of views is actually a wholesale caricature of actually why capitalism happens and happens well. And here I start because I think that the whole point about us human beings, and in fact the condition of the world, is that as I say in the slide, here I borrow liberally from Keynes. I'm a Keynesian economist, and I have a particular take on Keynesian economics. That's because I've read most of it, and also some of the best commentators on it, in particular Axel Leyenhofer's on Keynesian economics and the economics of Keynes. Anyone in the room who thinks that Keynesian economics is simply about a proactive fiscal policy and actually with a complete disregard for public debt to GDP ratios, please read Keynes. That's not what he said. And actually the kind of bowdlerization of Keynes and actually the tradition of economics and the way he thinks about capitalism is, I think, one of the great shames of our time. I wrote my first book on this called The Revolution That Never Was in 1986, saying this. I wrote another book called The State Room that some of you may have read or heard of 10 years later, saying this. And I've written another book just recently saying this. And I mean, the book, the State Room, according to the publishers, was the kind of second best-selling book on economics in the 20th century. But I sometimes think no one's ever read it, because if they'd read it, somebody somewhere would have started to say this kind of thing. I mean, because Keynes starts with the notion that actually there is Knightian risk in a capitalist economy. There is an unknowable future, of Donald Rumsfeld's world, if you like, of unknown unknowns. And it besets every business, and it besets you across the business cycle. It besets you structurally over time, and you can't expect an individual entrepreneur or businessman or woman to assume that risk, him or herself. As he said, it has to be mitigated, it has to be socialized. Understand Keynesian economics as the socializing of risk whilst respecting private property rights in a capitalist economy. No one thinks about Keynes in those terms, but please read A Treatise on Money and the General Theory and you'll get it. The whole framework of ISLM and all the rest of it, trying to reduce Keynesianism to actually the world of kind of outliers, a kind of world of idiosyncratic imperfect markets, is not the Keynesian proposition. This is. So if you're going to raise investment and innovation to optimal levels in your economy, you've got to have ways of companies to lay off and socialize risk, because there are and a world of coordination failures is not actually the idiosyncratic thing that happens occasionally if there's market imperfections. It is actually the condition of a capitalist economy. The extraordinary thing is a market that clears and does so systematically. So this kind of market failure framework that we've had operating in Britain ever since the war, you can only intervene as an explicit case of market failure, is completely to misunderstand, I would argue, the nature of capitalism. And so, what matters in a capitalist economy is the ecosystem that underpins the kind of the risk taking. There's necessarily a role for the public sector and government in actually kind of laying off and socialising risk judiciously. And the same thing is true, by the way, for ordinary men and women, who, of course, confront the same risk about what's going to happen over their working lifetime as business people do. The case for a social contract. That's where I start. So let's just, and I'm very sorry that I misspelled citizens, but there we go. Here's the amazing rise of the British banking sector. I mean, I do, for 100 years, bank assets in Britain were about 50% of our GDP. So for every pound of GDP, there was 50p that was lent, up until Competition and Credit Control. Chucks away, it goes up to twice GDP, it stabilizes in the 80s. We have the Big Bang, and whoops, bank assets rise to 5 times British GDP. The only country in the world which has higher bank assets than that in 2008 was Iceland. The Irish were at about 4 times. The Americans actually only got to 150. You'll see. I mean, it is really the most. It is the most astonishing thing. And of course, a lot of those not all that lending was in sterling. Less than a third of it was in sterling. Most of it was in dollars and yen. And actually, €1 trillion of it, of course, was in euro, meaning that after France and Germany, the British banking system is the most exposed to the euro crisis, and why it is a matter of huge importance to Britain that there is a European banking union. And it is, of course, we need a banking union to save RBS and Barclays from essentially going bust. We need to be in there discussing it, but as you all know, UKIP and the centre-right of the Tory party have put a veto on it, despite actually a growing number of people in the city saying we need to be part of this conversation. That was accompanied by this. Less and less capital underpinned that extraordinary rise in bank lending. And that was because the bankers said that they had discovered the alchemy of having bank lending 5 times GDP in a risk-free way. They developed structured investment vehicles that actually structured loans in such a way that there was no risk in any way. Even if there was risk, credit default swaps, a mechanism of insuring them that could be bought and sold between various banking institutions, would actually insure the loan against the extreme unlikelihood of it going wrong. It was complete bollocks, as we all know. What was taking place in this extraordinary rise in bank assets was, the stuff that you read about in this morning's papers. The other extraordinary thing about this is that only 5% of all that lending went to British corporations. Never in the history of world banking has so much been lent to so little purpose and with so little directed to genuine wealth generation. The great scandal of our times. And I'm afraid it's one of the reasons why I do consider Gordon Brown, Chancellor of the Exchequer and Prime Minister during this period, when the whole thing, as he is right up there as one of the worst stewards of our economy ever. This happened in his watch. And it wasn't as though people like me weren't saying this stuff, both in the book I wrote at the time, The State Ran and subsequently. The return on equity, of course, rose. It trebled from around 6% to over 20%. With all that leverage, what would you expect? And that had, of course, this impact on remuneration. This is average remuneration. This is what a PA makes in relation to PAs on average. That's the average remuneration. That's the excess. As you can see, have to go back to the late 1920s, early 1930s to have relative remuneration in financial services as high as that. And of course, this is going to do this. The balloon is going to be pricked, but we're all going to suffer. It had another phenomena, was that the legacy of that debt, the inability of the banks to now finance recovery, has meant that this is the longest recession since 1929-33. That is 29-33. We are 4 years into this and we're still 4% below trend. Where we were 4% or below trend, 4% below the peak level of output back in the second quarter of 2008. But the Office of Budget Responsibility don't think we're going to get back to that until 2013, 2014. Don't know, could be longer than that. So you go back to the period 1876 to 1893, the Great Depression of the 19th century, which of course incubated the labour movement, the rise of socialism, the rise of communism, the rise of the cooperative movement, the decline of liberal democracy. I mean, that was a hell of a period in British life. And I think that the period that we're living through and the consequence of the mistakes that were made and the mistaken policy to address it, to try and eliminate the structural deficit, public deficit, at the same time as you have this degree of private sector leverage, will be seen in years to come as a mistake even larger than the return to the gold standard in 1926. And George Osborne, I guarantee you, will be as repentant about it as Winston Churchill was going on to the gold standard, although in 1926. There was something else that happened, of course. You can't lend all that money without sucking in capital imports from abroad. And those capital imports forced up the exchange rate above its long-term equilibrium rate. That made it harder to export and easy to import, with this impact on our long-run balance of payments. Our balance of payments is going to get worse and worse, even though there's been a 25% devaluation of the pound. The traded goods sector in Britain has shrunk as a result of the doomsday machine of allowing yourself to have a financial system that generates that amount of credit and debt with floating exchange rates. Of course, and there is me and a mad dog in Sheffield thinks this, of course, had one entered the euro, this would never have happened. And Britain would have had a much larger traded goods sector than it currently has, and would be in a much better shape to face the crisis. And it would be part of the conversation about constructing a banking union to mitigate the impact of having a banking system as exposed to the euro as our own is. But actually, as I say, there's only me and a mad dog in Sheffield who think that. I'm sure none of you think that the euro is anything else but a bad thing, atrocious, and should be kind of generally ignored. Anyway, that's where we are. And I think we have to develop our way out, and I don't think we can develop our way out unless we embrace these notions of good capitalism. And what I try to, and these are just a set of kind of propositions really, about what I think, the left-hand side is what I think constitutes bad capitalism, and the right-hand side, good. And you can just run your eye down it and you can see where I stand on kind of all these issues. We've had a bias to unproductive entrepreneurship, celebrating those traders. We've been looking after incumbents and not celebrating the insurgents. Jonathan mentioned the Ownership Commission, which he and I were both on. We published a report 2 or 3 months ago trying actually to come up with some ideas about how one could get some more committed owners. On the commission was Roger Carr, who's president of the CBI and chair of Centrica. He was also chair of Cadbury's when it was taken over by Kraft 2 years ago. And he made the point, of course, and he much amused us, that actually on the morning of that bid he got 2 faxes, not emails, but 2 faxes from hedge funds in the United States reminding him that under British company law, unlike American company law, his sole obligation was to maximize the share price for whoever owned shares in the company at the moment that you had to vote, and that they expected him to maximize the share price and to basically sell Cadbury's to Kraft for the highest price. And if he had ideas about Cadbury's long-term value, he could basically stuff it, because British company law didn't allow him to express it. And one of the things we tried to do in the Ownership Commission was to come up with a framework of law and ways in which long-term shareholders could engage with their managements to permit, in such situations, fewer of these bids to come through than they have. There's a very good book by a man called Alex Brummer, who's an ex-colleague of mine, who now, amazingly, is city editor of the Daily Mail, who's written a book about the degree to which Britain is foreign-owned. And one of the other points about it is that we have very, very few of our industrial and commercial jewels remain under British ownership. And one of the things that I'm constantly struck at Oxford is that the fellows who do engineering or chemical engineering, work in biochemistry, very concerned that the number of British companies who will A, hire their undergraduates, B, hire their graduates, C, actually commit themselves to kind of long-term funding of research in Oxford are actually in decline, and more and more desperation about how one kind of is going to mitigate that. If that's true of Oxford, bloody hell, it's true of every university in the country. Anyway, you can see the basic framework. I mean, you need whether it's the workplace, whether it's the management, whether actually it's the relationship between the public and the private sector, a good capitalism has, I think, these characteristics and is underpinned by this fundamental value system. One of the things I think, one of the reasons why I think that people have got so excited about bankers' bonuses is because they feel that actually they are completely disproportionate to the contribution that has been made. And one of the things I did for the government in the first year of its life was to look at the growth of alleged growth in pay in the top of the public sector, to see whether there are any fairness principles, like, for example, having a 20-to-1 ratio between top and bottom, that might be introduced that could also be rolled out across the private sector. I came up with the notion of earn back, that actually you should place, if you run an organisation, part of your pay at risk and earn it back through your contribution, and only make a bonus to the extent that you've actually done your job properly. And that people understand that as a way of legitimising incentives and also having a conversation about what a good job might look like. It's got a raspberry from some of the trade union movement, but even bigger raspberry from the denizens of the 1,000 men and women who run Britain's FTSE 100 companies, because, of course, I argued that everybody in the private sector should also sign up for the same thing. So, you know, if you want to get, at the moment, base pay on average in Britain for a FTSE 100 director is about a CEO is about $1 million, and then there's pay on top is about $4 million in bonuses and long-term incentive plans and the rest. And I argued that actually it's a complete asymmetry, and that if they wanted to be paid as capitalists, taking capitalist risk, then actually they should put the proportion of their base pay at risk, say $500,000 if you've got $1 million base pay, and then only get a £500,000 bonus to the extent that you'd actually made your base by doing your job well. If you read some of the remuneration reports, and I thought that Mr. Hester's remuneration report, he got a base pay of $850,000, he had an opportunity to make another bonus on top of it. Remember, opportunity for a 100% bonus. When you looked at the Remcom's definition of what Mr. Hester had to do as chief executive at RBS to make that, it was essentially doing his job. So to do your job, you get nearly twice your base pay as a bonus. And so, you know, this notion of earn back is attacked. You know, the left don't like it because they don't like the notion of performance in the public sector. They think it undermine the public ethic, and the right don't like it because it means that actually you're held to account about the kind of money you make. And it's not all about Martin Sorrell standing up in a day program and saying, you know, my mate gets paid much more than me in America, so I should be paid the same, and if I don't get it, I'll migrate. You know, that's a raspberry to that, Martin. You know, what's the contribution you've made running WBPP? Are you actually worth 12 million quid? Anyway, these questions people in bad capitalism are happy to justify. Good capitalism is kind of trying to create an environment in which that becomes a harder sell. Okay, I'm going to go through this very quickly, actually. Where's the future? I think the future lies in the knowledge economy in general. That's the private sector knowledge economy in the 80s, leading recovery. That's it in the 90s, that's the red line. Here's the knowledge-based SMEs doing bloody well since the mid-1990s compared with non-knowledge-based SMEs. And here is I wanted to take some of you may have seen me talk about this. If you've read my book, Them and Us, in chapters 4 and 5, I discuss general purpose technologies. And I like to discuss these because this was the inspiration for the big innovation centre. A general purpose technology is, and the reason why I want you to spend a little time thinking about it, is I do think that we're living in a period of accelerating technological and scientific change. And actually, here's the point, is it will be those countries which have structures of good capitalism and the ecosystems to support good capitalism that will best exploit the opportunity. So if you're thinking about how to develop your economy, which is where I think we are, this stuff is really rather important. A general purpose technology is a technology which has a general application, a sailing ship, or a railway, or an aeroplane, with multiple spillovers, and which contains within its own DNA the capacity to be a very different piece of technology, but recognizably the same over its life cycle. The internal combustion engine in your Audi is the same as in a Model T Ford, but my God, is it different. And same is true for all of this. Big point is that the rate of introduction of these has accelerated. If there was time, and there's not, I'd like to turn, and perhaps in the Q&A session, and we'll come back to this, I'd love to tell the story of the three-masted sailing ship, or the railway, and how they changed the world, or the internal combustion engine, or the internet. But I mean, you kind of get it, I hope. The point is that science is growing exponentially. Scientific exploration goes 2, 4, 8, 16, 30, just multiplies 32, 64, and it crosses boundaries. So, and I won't do this again because it's kind of boring, but there's a guy right across at Oxford who's at my college who's just invented an amazing machine. His name is Hagen Bailey, that actually is the size of a mobile phone. He's a chemist, but actually he's combined with biologists to create a machine that can read the molecular structure of your genome in 15 minutes. And it'll be on sale for 1,500 quid in the next 18 months. The point is that not only is not only is science moving in leaps and bounds, it's also crossing boundaries. Here's the point: there will be not 9 GPTs in the 20th century, the 21st century. There'll be 20, and they're coming in faster. That's the waves in which they've come in. That is the 60 years in the steam. Now it's taking 20 years for these technologies to roll through. Here's some of the areas in which there will be, I think, GPTs. I think self-repairing machines will be one of them, actually, and some of the advanced materials in the fourth bullet point are a big area that's going to break quite quickly in Britain. And here's actually how one, I think, thinks about it, about the exploitation of this. Again, I haven't got enough time to talk about this in detail, but this is what we're developing at the Big Innovation Centre, is the kind of ecosystem approach to thinking about this. Absolutely, this is not. If you're thinking about the rollout of these technologies, you need to escape the way American neocons and actually the Faculty of Economics in if we get peer-reviewed in American journals would describe how this process happens. It isn't about people having light bulb moments and responding to signals in markets. It is, it's a very complicated interaction between the kind of infrastructure that supports knowledge generation, how entrepreneurs exploit it, both within firms, large firms, startups, and SMEs that are scaling up. There's got to be, of course, enormous variety of ideas will come out of this. There'll be, there will be a process of selection. I mean, which will be, we don't know which will become the dominant design, which then scales up. As it scales up, you have to mobilize skills, resource, finance, equity, markets, before you go round the circle again. And the whole thing has to be open. Of course, what happens in these arrows, as Professor Anderson says, is as important as what happens in the circle. The actual process of going from there to there, and the way in which ideas and resources and information flows in these arrows is as interesting as what actually takes place within one of these circles. That is the heart of this kind of ecosystem approach, but you won't get, if you want this to happen in a capitalist organization, you need biases to productive entrepreneurship, biases to banks that are kind of genuinely trying to grow their client's business rather than actually get bottles of Bolly for kind of manipulating Libor. Our universities have to be much better networked into the business community, and the business community itself has to have a capability of exploiting the ideas that actually come out of our universities. And it's a huge bloody challenge to get a thing like this going. It's about values, it's about corporate law, it's about doing the things we argued for in the Ownership Commission, it's the things we're arguing for at the Big Innovation Centre, and I haven't touched a bloody, a tenth of it when I talk about that. I think I've explained that. These are just slides which we can come back to in the Q&A session. But if you think that is interesting, it's Business Week here at Birkbeck, what strategic question for firms in an environment like this, where actually, in sector after sector after sector, the business model is going to be kind of reinvented. I sometimes like to say this, but it's, I'm on the Scott Trust. I've been 7 years on the Scott Trust, the director of the Scott Trust. I have 3 more years to serve. We own the Observer and the Guardian. And I've watched newspaper circulation in this period decline by 9% a year for the last 7 years. The question is, will it, like sales of DVD, just fall off a cliff in the next 2 or 3 years or not? Here is a, so what business is the Observer and the Guardian in, if it can't be in the business of actually delivering your news and comment in a written newspaper, nationally distributed, available in newsagents? And what is the ecosystem that supports it if you're not going to have, the Royal Mail and the Rail Network and newsagents and goodness knows whom supporting you? And how are we going to innovate our way through to something else? How are we going to use our readers to develop a different kind of newspaper offering? And how are we going to build an absorptive capacity in the Guardian and the Observer to actually external influences? And actually, it doesn't matter whether you're, thinking about the Guardian Observer, or whether you're thinking about running a pharmaceutical business, running an IT business, whatever you're in, these kinds of questions are becoming fundamental, as they are for governments. And the Heseltine review, I made this kind of pitch to Lord Heseltine, and saying that the way he and the government should think, and I think any Labour government should think in the same way, those are the kinds of questions that they should be asking about how to support business growth in Britain. This is the Big Innovation Centre. I think I should spin through this actually because time is pressing. If you want me to, I'll talk you through what we're doing at the BIC. I chair it, and your former colleague is its director. It's growing like dropsy, and we are anxious to, we're going to grow more, we hope, and we hope that we are going to be, we hope to be an open innovation hub that will be a catalyst for companies and actually the government thinking in these terms too. I just want to finish off, I think, by saying what do I think what does this mean for kind of economic policy and business policy? I think that I do think that someone leaving Birkbeck now, and I can see in the audience that some of you are there you are, you're 20 or thereafter. You are going to work till you're 70. I'm afraid you may even work till you're 75. And during your lifetime, you will see more change in business models than has been seen in the last 300 years. So you can be certain that whatever skills you are kind of going into the labour market now, they'll be redundant during the course of your life. And you can also be pretty certain that the companies that are hiring you today will be not around or will be merged or competed away at an ever rapid pace. And the average age of a Fortune 500 company in the 1950s was over 40 years. Today it's 12 and it's falling. The only way that companies are going to get anywhere is by, in my view, and in our view at the Innovation Centre, being open innovators. And I think it's the states actually a kind of a world. And I think this is where I thought the kind of Beecroft report, where Beecroft got he really got it in the neck, this venture capitalist, who was saying we need to make it easier for firms to sack workers if they're going to hire workers. And actually, I'm afraid he's right. Because, if you're a company employing 20, 30, 40, 50 people in this kind of environment, you're not going to be around long. And you've got to be able to adjust your labour force upward or downward very rapidly. But the big point about it, what was wrong about it, was that actually he was trying to remove a workplace entitlement, the right to proper consultation and redundancy payment, without actually offering anything in return. He was trying to increase workplace risk as a bad capitalist without thinking in social contract terms about how you might reframe the social bargain at work. And that is why his report went so badly wrong, in my view. So to wrap up this lecture, here's where I think economic, social, and business policy goes if we're going to get out of the hole we're in. And, you know, no one should have any illusions how big the hole is. I mean, we're talking about, you know, unemployment sticking above 8% for the foreseeable future, underemployment staying astonishingly high. We're talking about an amazing squeeze on living standards that is going to be sustained for years ahead. And I think that if you do take the view that I do about the role of the state and about the socialization of risk, then the first thing we have to do is we have to have a growth target along with an inflation target, and we have to have we can't have the Bank of England running around with an inflation with their inflation target independently of the government with its fiscal policy, independently of the FSA and its financial policy. You have to pull these things together if we're going to get banks to grow their balance sheets, even while their balance sheets are overextended. We're going to have to provide them with some guarantees on their lending. And I proposed in a paper to the Banking Commission, and I continue to do it, that actually we need to offer the banks a guarantee for part of their new lending. So for every £100 of new lending, they're not the first £15 of the loan, but the next £15 of the loan would be indemnified by the taxpayer. Those loans could be parcelled up into a structured investment vehicle or an aggregated piece of paper. I'm going to open-minded of what it should be. But with the indemnity, we can create a secondary market in it, and actually it'll be AAA paper, and the Bank of England can buy it with its quantitative easing program. You invent a conduit by which the Bank of England's QE money can go straight into new lending in British SMEs and in the larger British corporate sector, which is not what's taking place at the minute. There's £375 billion worth of QE taking place. There's less than £1 billion of that is actually commercial paper. The rest of it is government bonds. Extraordinary. Particularly as when Alistair Darling gave the initial agreement to it, he argued that 30% of the money should go into commercial paper. And he was ignored by the governor. Had that taken place in any other walk of life, the man would be sacked. I mean, the idea that actually there should be a public debt to GDP target of 70% when interest rates are the lowest for 300 years is comical. And what matters is debt service obligations, not your public debt to GDP ratio. What matters is the interest rate, the term structure of your debt, and how much debt you've got. And you keep a weather eye on it. It shouldn't be an overall constraint. And of course, as you all know, with interest rates the lowest they've been since the Treaty of Utrecht in 1714, and that's incredible. 10-year bonds in Britain, 1.45%. As the term structure of British debt is 14 years, debt service requirement at the minute is 3% of GDP. There's only been about 3 decades since 1750 when debt service in Britain has been so low. So we don't have a public debt problem at all. When you hear David Cameron and George Osborne talking about the debt constraint, they are talking absolute crap. It doesn't exist. We do not have a, in the 1930s, debt service obligations ran at 9% of GDP. They're currently running at 3% of GDP. 3 times higher in the 1930s, when, by the way, we began to expand the public deficit because we wanted to fight Hitler. And we need to have a discretionary fiscal policy within a measured 10-year, not a 4-year, deficit reduction plan. We've got to give businesses some sense that actually there will be, through a money GDP target, through de-risking new lending, through using the maximum of discretion to get infrastructure spending going, that actually the demand in our country will go up 5 or 6 or 7% for a decade, reducing the real value of the debt overhang. But that is not enough. You've also got to get stuck into the ownership, investment, innovation ecosystem. I've said quite a lot about that in the last few minutes, and we're already going to 7:30. but I mean, my thinking is, ownership, commission, stewardship, an innovation ecosystem that permits mitigation of risk, getting really seriously into developing a national catapult network and getting the TSB to kind of, we need 2 or 3 times the size. We need to get serious about developing a British equivalent of the German Mittelstand. And of course, I think, never to forget my point about proportionate reward. A lot to say about this. I'm planning on writing a little kind of pot boiler over the summer as an e-book, which we'll put on there, so you can all dash off and get that offline, which will set all this out much more clearly than I can do in this short lecture. And I think we have to do a 21st century social contract. I can't bear this world in which the only question we ask about social spending in Britain is it affordable, not whether it's reducing risk to ordinary men and women. It's, I know, and I think we have to rethink the role of what trade unions are about in this good capitalism of mine. I see trade unions as holders of managements to account rather than shock troops in the kind of language of the 1960s shop steward movement about to socialise capitalism. I do think that you need to underpin the social security system with social insurance. I can't bear this language in which people who are living, through the brute bad luck of being born in the wrong part of the country, or in a social housing estate, or the luck of brute bad luck of having been terribly parented, are then accused of making lifestyle choices because they live on benefit. We have to create a social security system in which actually you pay in, and it is your right to get the benefit because you've contributed. It's your due desert because you've contributed to get the benefit. That was the Beveridgean privilege, the Beveridgean principle, and I fundamentally agree with it. Mr. Beecroft might have been right about wanting to make it easier to hire and fire. If you're going to have less job security, there must be genuine system of lifelong learning. There must be better unemployment benefit as people transition through periods of unemployment, which is on a social insurance basis. And if you're out of work after 2 years, the state must act as an employer of last resort. You cannot increase workplace risk for ordinary men and women in today's environment and just walk away from your responsibilities. On the other hand, you have to confront the reality of today's workplace. Housing is a complete disaster, and the collapse of the building society movement, the inability of too many people in social housing to borrow on their own account, the paucity of new housing, incredible. And not opportunity, but I'm a great admirer of the German apprenticeship system. We have 2,000 apprentices in Britain being educated to the equivalent of level 4. In Germany, there's over 50,000. Say no more. Look, what I try to do in this short 50 minutes is to try and spell out a vision of how to do capitalism better. A vision, I hope, because it's underpinned by these notions of fairness, would command wide support across the British electorate. I've tried to argue that what the nature of risk is in a capitalist society and how it must be mitigated by an active, agile, smart and enterprising state. I've tried to kind of lay out where I think monetary policy, fiscal policy and financial policy, ownership and investment, innovation policy and social contract policy all interlock to underpin a better society. I think if we did these things, give or take, I think we could float our economy kind of off the rocks. I really hope that they start to gain some traction. One of the encouraging things is that the number of companies that have come to associate with the big innovation centre and who buy into this framework. And even in Barclays Bank, there are top executives who are absolutely appalled at what's taken place in investment banking and want their bank to be in a different place. There is hope amongst all this gloom, and I hope my invitation is to at least argue with this rather than trash it. I think it has, I can't think of a better way of getting out of the state we're in. Thank you very much.